Hey everyone, we will continue to talk about precious metals. The last video was about gold. Today I'm going to talk about silver. And I think that the world has given us the perfect conditions to invest in precious metals, or at least to talk about them. So what drives the price of silver? What are the economic conditions that are making this a good time? Are we missing something important? So if you want to listen valuable information that drives the price of silver and all the insights, you should definitely watch this video. So I will continue with the silver price analysis and the complete market forecast. So one of the most important indicators that we have today, and one of the most surprising thing, is the gold-silver ratio. And this is an indicator that will tell us why it's now being so attractive to invest in silver. So the gold-silver ratio is simply the amount of silver it takes to purchase 1 ounce of gold. So in this case, for example, the all-time high has been like 115 ounces of silver to purchase 1 ounce of gold. And the all-time low, it's 15 ounces of silver to purchase 1 ounce of gold. And right now the current ratio has spiked with the pandemic issues and everything. So this indicator is one of the main drivers. It's attracting a lot of investors to invest in precious metals. And how to read this? So when the low silver ratio is in the lower territory, it tells you that it's the best time to buy gold. When it's high, it's the best time to buy silver. So why is this very desirable? Why the gold-silver ratio many follow it? Because basically proportions and percentages are more accurate because prices are changing all the time, and as well the money supply that it's injected into our economy basically distortions the reality of price fluctuations. So the gold and silver ratio, it's basically a very credible tool to invest in gold and silver. Before getting deeper into our analysis, I wanted to give you like a big picture of what's happening in the economy. Our economy is melting little by little. Basically, there's a huge gap dividing the real economy, which is what it's happening right now, and the financial economy. So in the real economy, it's basically the real world, the social unrest before and after the pandemic. Do you remember the strikes all over the world in China, Mexico, Chile, as well Catalonia? And after, there's like lots of social unrest. There's like overcapacity in the industry. Do you remember the oil prices collapsed? So consumption went down as well. And many businesses closed. They couldn't survive the lockdown. And there were like millions of unemployment claims. Nothing is compared to what is happening right now in the financial economy, where stock market is going up. Basically, they're like making millions of dollars in the stock market, not reflecting to what's happening in the real economy, because the stock market can remain irrational more time than you can stay solvent. That's why it's very risky to invest in the stock market without knowing. So I want to disclaim now that I'm not a financial advisor, so please do your own research. And before continuing, remember you guys to subscribe to the channel to get the most valuable financial insights. So I'm going to talk about the interest rates of the United States versus the money supply. And this is the Federal Reserve balance sheet of the United States and how they have been lowering the interest rates during times of crisis, right? So basically how interest rates work. When interest rates rise, basically this is when the economy is doing well, increasing the cost of money, making harder to get loans from banks and between them. And when they are low, the central banks ease money to decrease the cost of loans, making it easy for institutions to access money to match the reality of the market. Before the 2008 crisis, they were up, and when they turned down, basically there's like high probability of a crisis. And during the 2008 crisis, basically interest rate went down almost to zero and remained like that with lots of quantitative easing, which is the money printing that everyone is talking about. And they raised the interest rates again. And after the pandemic breakout in the world, they collapsed again, almost to zero. I think they will remain like that for a long time. Another thing is that all the central banks around the world are doing the same thing. And even there are like some economies in negative territory. We have here the United States, which is this area, but compared to other economies, we have Canada, the United Kingdom, Japan, and the Euro and Switzerland are basically negative territory with negative interest rates. What I want to communicate with this is that debt is usually a tricky remedy to keep sleepwalker companies alive and postpone difficult restructurings that lead to political conflict. So governments tend to ease money and prefer to increase the monetary base to pay for the problems rather to do uncomfortable confrontations and debt restructuring. Many nation states have rise and fall. Empires and nation states end when they start debasing their own currency. It doesn't mean that it's the end tomorrow, but we should be aware of the economy. So I want to talk about the velocity of money that I explained in my last video about gold. For you, I want you to recommend to watch that as well. And well, what is the velocity of money? The velocity of money measures how quickly $1 moves through the economy by tolling the number of times it gets spent per year. This is basically how many times $1 moves to buy products or services, creating value, right? Because every time something is sold, it's because value was created or someone was helped through services. And with the recent recession and the huge expansion in the money supply, they have decelerated the money to its lowest pace record. What we need to be afraid of, it's because the money supply increases the prices that could lead to hyperinflation. And here's a small formula, which is the price formula, looking at it from an economical perspective. And this is the monetary base, the velocity of money that I'm talking now, and the value created, let's say. So if you increase the monetary base and the velocity, well, this is basically rocket fuel for prices. So this is what we should be afraid of in the economy. I'm going to give you the economy at glance today. So fiscal stimulus that I was talking about gets to companies with overcapacity and people with risky financial profiles. And what is the overcapacity? It's a state where a company produces more goods than the market can take. And on the other hand, personal savings are decreasing all around the world. The purchasing power, it's getting absorbed. So fiscal stimulus, it's diluting people's savings because new dollars injected into economy detract value from existing dollars. And this is happening because they are increasing the monetary base in unprecedented amounts. So cheap money caused by low interest rates and quantitative easing, it's arriving to wrong hands. When they lower the interest rates, basically it's cheaper to lend money between banks and people and companies because the cost of money it's lower. So this gives greater purchasing power to inefficient companies and people without savings, raising lots of questions about financial stability. So investors tend to seek more secure investments to lower the risk of their money or their investment portfolio. That's why they normally tend to buy bonds in difficult times, but this time, this didn't happen. One of the things that will be remembered during the crisis is that the bond market dried out on March. And this is the way government finance themselves from international investors to incur in deficit spending to pay social programs or wars or whatever your local politicians are promising, right? So deficit spending has increased dramatically in the last decade, all around the world, basically in Europe, in the United States, and also in China. The cost of servicing that public debt, which is the bond market, is dependent on the gap between the real interest rates on debt, which is the amount that will be paid to investors, and the growth rate of the real GDP. Okay, so I want to recommend you my video of gold that I did last time. In the corner, you can basically click and go directly through it, so you can see about the bond market. So the difference between the interest rates the government must pay to its lenders in real terms and the pace at which the US income increases will determine the cost of the debt. Okay, so if US income increases more rapidly, then interest payments on US debt shouldn't be a major burden. Here in the chart, we can see that since 1960s, the negative debt servicing costs have remained in negative territory. And on average, around 60% of the time, they have remained like this. The only time that in which the real interest rate was consistently greater than the growth rate of real GDP was from 1981 to 1995. So with the increase of money supply, with the recent increases in money supply, research has shown that budget deficits, income decreases, and low savings, and with all this combined, it could reverse to the upside. And this is where things could get really complicated. Right now we're in negative territory, but when things turn to the upside, that's when things could get difficult. So what drives the price of silver? Silver has always been an industrial precious metal, where jewelry is made, technology has been manufactured, and the silver production comes as a byproduct of other metal mines, such as zinc, copper, or gold. Central banks normally make their own fiat currencies with zinc, copper, and other metals. So silver comes always as a byproduct. They don't extract directly silver from the mines. It's a byproduct. So there's, as well, with economic turmoil, silver prices tend to rise, and the gold price also fluctuates and influences the price of silver. As well, inflation would be the main reason, and this is basically rocket fuel for silver. If inflation kicks in, it's the perfect scenario for silver. Silver will go up for sure. And a weak US dollar and the stock market. When the stock market is not giving investors what they want, they tend to go for precious metals like silver and gold. And why silver supply falls? Well, the declining mine production due to low base metal prices makes the silver price go down, because they don't look for other precious metals because it's a byproduct. As well, the declining silver mine capacity, because sometimes it's a scarce resource and they don't have the capacity to extract all the silver. Declining reserves of silver in central banks. When central banks don't demand silver, well, the price goes down as well. And normally in the past, they tend to demand more silver because our fiat currency, the fiat currency was made of silver. The coins were made of silver. Right now, everything is electronically, and coins doesn't contain silver. They just contain anything else. Right now, maybe because of the economic conditions of the world, central banks could start demanding for silver as reserves. So this could really influence on the price of silver. I want to make another parenthesis for you guys to subscribe to the channel and give the thumbs up so you can get valuable information about finance. I want to talk about inflation rates as well. This is a historical chart of inflation and deflation, right? From 1785 till our days. So we can see three parts, two major events. So there's like something before the Federal Reserve was created, and there's like an after when Nixon ended the gold standard, right? So right now, with these fluctuating fiat currencies, deflation would be the horrific time for governments. And why is that? Because they will get less power. And they have many tools today to prevent inflation. They are really they have all the tools available because they can raise taxes. Basically, when they raise taxes, people tend to spend less because they have more obligations. So they can also put tariffs on products, increase them or decrease them. They can fix some prices on essential raw materials by law, like maybe rice or bread or milk, be essential for their own population. And as well increase the reserve requirements on banks, or they can even destroy money, because the Federal Reserve and other central banks are really allowed to do that. Here's another chart zooming in the last 20 years. Okay, this is the same chart as the previous one, but this is the last 20 years. So we can see that in 2008 we have like lots of deflation, right? So this is not good for the economies, and this crisis lasted so long. So that's where governments don't want to go. They don't want to go into negative territory this time. So that's why they're doing all this quantitative easing, all these helps, all the central banks pushing further and further and increasing the monetary base to pay for the problems, basically. So why states, nation states and central banks fear deflation? Because when there's deflation, there's less taxes. So when there's less taxes, they basically have less income, government income. And there's also less power. When the government gets less income, they have less power, and as well less state, less nation state. And because lots of people get fired during these turmoil times, more the job losses increase. And there's the inconvenience of restructuring of debt with other countries. So when there's deflation, basically an economy collapses and the state is basically weak against other nation states that are stronger economically. I want to tell you why, what are the main drivers to invest in silver. One of the main drivers to invest in precious metals is that it's the best natural conductor of electricity and heat, and it plays an important role in the production of green energy and technology. There's also an increased government spending and money supply that are sure paths to hyperinflation. So when there's hyperinflation, silver price tends to go up as well. So there's like lots of research that has shown that budget deficits amounting to 40% of the government spending are sure paths to hyperinflation. And most of the cases, a deficit of 20% already caused hyperinflation. We have many examples like Venezuela or Germany in the 1930s, and there's like a huge list of these hyperinflation cases that you can look out in history books. Once a turning point is reached, inflation tends to accelerate and no one can stop it. That's where, in this phase, currency substitution sets in. This is basically where, when there's like huge hyperinflation, governments will want to change and substitute the currency. And there's like dollarization occurring in the economy. There's lots of demands of dollar, of course, but we should be very attentive of what's going on in the economy and if more money and more debt is increased in the future. One of the things that, one quote I want to say is that if goods cannot cross borders, armies will. Right now there's like lots of protectionism. When there's like lots of protectionism in the economies, trade gets more difficult and raises conflicts among states. Like fertile ground for wars and conflict and everything. One of the things that neither the mainstream economy nor central bankers can control the specifics of inflation dynamics, because the economy has as well some psychological part in it. When people feel sure and they start to spend all the money that was created during this crisis or during the last crisis, well, hyperinflation will kick in, and no one knows because no one can control human psychology. This is one of the things that we should be aware of the economy, and silver is a safe investment. It's a safe asset when in times of turmoil. So not having silver or even gold right now tends to be difficult, and it's better to have it just in case. And as well, it could turn out to be a great investment for long term. Okay, so I want to remember you guys that I'm not a financial advisor. This is not financial advice, and you should do your own due diligence, your own research, and approach to precious metal with a deep research, because you could really lose all your money. Please take into consideration all the information I gave you and question it. You can comment below and give me your thumbs up. I want to remember you guys to subscribe. It's great that you arrive until here. So please subscribe to the channel, and you will get some very valuable videos that you will be they will be very entertaining. So thank you so much for being here, and see you next time.